I want to bring in a global equity strategist to talk about this. Unfortunately, we have one sitting right here. Jeff Palma, head of global equity strategy for UBS. Jeff, what do you think about this bill? I mean, Carol and I were talking about this earlier. It doesn't seem like maybe the most intelligent move since obviously China holds a lot of our paper.
Yeah, I mean, I think it's a little bit of a surprise that the bill has gained as much momentum as quickly as it has here. I mean, it's clearly meant to put some pressure on the Chinese to continue to allow the currency to appreciate. Since they made the original announcement in June, we've gotten less than 10% appreciation. We'll probably get a little bit more over the course of this year, but it's pretty clear that the government would like to put more pressure on, especially heading into this political season, the election season, to get more appreciation as next year goes on.
Do you really think it would make a huge difference? I mean, if China let its currency slide up 20%, would you go out and buy a ton of U.S. exporters?
No. I mean, at the margin, it'll, of course, make the U.S. a little bit more competitive. But we know that from the U.S. economic perspective, exports are pretty small, right? And so that's where I think this ends up being slightly more of a political issue. But it's pretty clear that it's one that holds some sway these days.
Do you think though, it is stupid, going to Matt's point? I mean, China does hold a lot of our paper, and also they're the growth engine of the world, no doubt about that. Are we being stupid and this short-sighted, if you will?
Well, I mean, it's pretty clear that the currency, the weak currency in China has been mutually beneficial to China to the extent that they can have strong export growth, but also then they can buy U.S. treasuries with all their capital flows that they see and, right, the very strong surpluses there. So in the end, we need to see rebalancing. There's no question about that. We need to see exports slow in China.
But is this a little short-sighted?
This is probably a little too soon for that, I would think. Yeah.
All right. And Jeff, I want to pick up on Matt's thought, and that was, we were talking about China. Do you think ultimately this will lead to a trade war?
Well, I don't think a trade war is in anybody's interest, that's for sure. And so it's kind of like a giant game of chicken, right? You're basically trying to take everybody to the brink. The U.S. trying to push China to revalue their exchange rate a little bit higher, a little bit faster. The Chinese pushing back. I think no, in the end, we probably won't see a trade war. Economically, it's just damaging.
Right?
That's right.
Is it even really about trying to push China to the brink, or is it really about politicians in Washington trying to flex a little muscle before midterm elections?
Well,
because
that's definitely
do people really believe that if China ends the peg of its currency, that we would all of a sudden get all of these jobs back, manufacturing things at $7 a week? And I mean, clearly we're not going to get those jobs back, and we don't want to pay the prices that we would have to if we did.
Well, that's the point, right? I mean, what we're buying, what we're importing from China is at a cost that we couldn't produce here domestically, right? And so I think the idea that we've lost jobs to China over these last however many years is just wrong. We've chosen to export other things. We create things of higher value. Our labor costs are just too high, and we can't compete with Chinese labor costs. So revaluing the exchange rate doesn't change the problem.
So as an investor, a global investor, what do you want to be more exposed to, the United States or China at this point?
Well, I think emerging markets still, right? I mean, we have all these tensions, and that may add to volatility and uncertainty and all those things that are resulting in pretty tough market conditions. But the underlying growth in emerging markets is clearly better than we see in the U.S. In China, it's better. Valuations are better. And in that respect, that's kind of the engine of the world. From a growth perspective, I think that's where you want your equity exposure.
It's interesting. You say potential additional quantitative easing from the Fed is better news for emerging markets. Why is that?
Well, it's certainly, I think, to the extent if we're getting additional quantitative easing because inflation expectations are low, it's liquidity that's being added, right? It's stimulus to the world. To the extent that Asia imports U.S. monetary policy and U.S. interest rates, that becomes very, very stimulative for Asia very generally, right? And I think that we'll see capital flows move towards riskier assets. And in general, I think that favors emerging markets as well.
What specifically?
Well, I think Asia is a main beneficiary. The currency pegs, to the extent that they exist, mean that they take U.S. monetary policy. We can also see those growth regions and areas where we see higher interest rates in those markets than in the U.S. benefit. And so that's not only Asia, it's also markets like Brazil. But I think Asia as a block really benefits most clearly.
What specifically, though, in Asia, then? Where do you play it? Where do you allocate your money at this point?
So from our perspective, we like China. We like Hong Kong. I mean, that's direct plays on the U.S.
But not all of it. I mean, I think about Jim Chanos, who we talked about. He talked about the real estate market, and everybody talks about a bubble, and he's shorting that area.
We don't believe there's a bubble in the real estate market, right? I mean, you may get to that point. You may worry about asset prices, right? But over the course of the next 6 or 12 months, you could still see things go quite far. Our view is that property is being cooled, but that the central bank is doing a pretty good job controlling that. And if they are, and if those property measures that are coming in, there were some more announcements today about trying to enforce those restrictions a little bit more. If everything plays out, you should get a soft landing in China, and that'll help, everything pretty generally.
Well, and you're not a you're not a bull on U.S. markets or developed markets, are you?
Well, I mean, I think I would say in a relative sense, no. We would prefer the emerging markets. We would prefer other markets over the U.S. What I would say, though, is that valuations in the U.S. and the other developed markets do look pretty reasonable to us. I think there's a fair amount of uncertainty and headwinds.
But what about if earnings estimates come down?
And they probably will.
Then does it look so attractive?
Well, not as attractive. But when you talk about bond yields where they are, when you talk about corporate bonds where they are, when you talk about the ability for the economy to grow over some sort of a medium-term horizon, I think valuations can expand, but we are likely to see, in our view, earnings downgrades over the course of the next few months.
All right. Hey, Jeff, thanks so much for joining us. Jeff Palma, global equity strategist from UBS.